welcome to our July professional advisory workshop. It's hard to say July. I still wanted to say spring, and spring is over and summer is just about over, right? So again, we thank you so much for taking time to be with us today. I'm Kate England. I'm honored to serve as the president and CEO of the Community Foundation of Northeast Iowa. And we really do appreciate the opportunity to say thank you to you and provide lunch for those that made it here today. And then also to provide the CEUs and just important information that'll help hopefully strengthen our sector of professional advisors here in our region. We're so grateful for the ways that you connect with our organization and refer clients and donors our way. Really is an awesome opportunity to be able to sit down with you and your trusted clients and donors and talk about how we can help them reach both their charitable goals and their financial goals. And we just really appreciate that partnership. So again, glad to be here with you today. I'll give a shout out to some of our board members and committee members, I think, that are with us today. I believe Todd Henningsen is on, maybe not. He's our chair of our board, or vice chair of our board this year, and also chair of our investment committee. And I see Brooke Trent is on. Brooke is on our board. I know Pat Mona is here with us today, who's also on our board. Stacy Brass, who's on our investment committee. You know, we're always looking for community members that are interested in being a part of our volunteer sector. We have over 300 and about 25 volunteers that serve across our region in various committees or on our board or help with our local community foundation, our affiliate work. So if you're interested in being a part of any of those committees and things, please let us know. We'd love to share more details about what that means to be engaged in that kind of work. So I'm going to go ahead and turn it over to Lori so we can get on with our exciting program today. But again, welcome and thank you for being here today.
Thank you, Kate. All right, well, good. It's officially afternoon now, so I'm going to say good afternoon to everyone. I'm here in the room, and those of you who are joining us remotely, we're happy to have you with us for our professional advisor series. We host these events throughout the year, 4 per year, and we certainly hope that these opportunities to learn together are meaningful and helpful to you in your practice. So today's session does have continuing education credits available for those of you here in person or remotely. Hopefully everyone who's here in the room had a chance to sign in to let me know if you need information on the continuing education credits. And for those of you who are joining remotely, and actually everyone, I'll follow up with an email that has that information about the number for the CLE credits and to get information for you if you need the CFP credits, so you can get me that number. So just want to to ask you to kind of look out. We are planning for this fall to do a survey out to our professional advisors, those who have attended, those who are in our network, to kind of talk about upcoming events. We'd like to find out what types of programs that you would like to get more information on. Talk a little bit about time of day. Is this still the best time of day? Day of the week, all of that. So just to kind of get some feedback. So we'll look forward to your thoughts on that when the time comes. And I think I'm going to go ahead and introduce Eric, who's our speaker today. So we are very happy to welcome Eric Hanna from Hogan-Hansen today. Eric joined Hogan-Hansen in 2012 and is a tax manager in the Waterloo office. He performs research on complex tax-related topics and is responsible for preparation and review of individual, partnership, and corporate tax returns. So Eric plans and conducts audits, review and compilation engagements for local governments, nonprofit organizations, and commercial entities. Eric graduated from Coe College with a BA degrees in accounting and business administration. He's married to his high school sweetheart, and they have 2 sons. And in his spare time, he volunteers for his son's baseball teams, where we just heard that just finished up. So now he's got a little bit of his life back, and has also served as a treasurer for the Marion Economic Development Company, nonprofit organization. And during the summer, he enjoys spending time at Lake Delhi. So we are very pleased to have Eric with us today to talk about recent tax code changes, which apparently is very exciting, because I don't know the last time we've had this many people remotely joining us. So whatever it is, we're going to keep up with that. But anyway, so please help me welcome Eric. do that. I gotta get the sign back in.
Right. Well, thank you for having me. A little bit about Hogan-Hansen. We're 5-office CPA firm throughout Iowa. So Ames, Ankeny, Mason City, Waterloo, and Cedar Rapids. Full service accounting, so audits, big companies, small companies. We do a lot of governmental nonprofit audits, and then also bookkeeping, monthly service, payroll, and then obviously a lot of taxes throughout the year. Or like,
There's your clicker right there.
thank
So,
you. All right. So just to give you a little warning, I do not do this a lot, so feel free to ask any questions or hop in whenever you want. It's more of a discussion. This is very new. So there's still some parts we're still reading through and trying to figure out still a little bit. So a little history on the Iowa tax reform. It actually started back in 2018. They came out with an overhaul, significant overhaul, but it was all contingent on revenue targets. They did not come out and say specifically what these revenue targets are, but they did say, over the next so many years, there's going to be a gradual rate reduction. And then in 2013, there's going to be a significant overhaul. But again, they didn't really tell us what the revenue targets were. So for the last 3 years, we've actually seen a reduction of the overall tax rate from almost 9% down to 8.5%. There's 3 different, actually there's more, there's 5 different brackets. And also they allowed businesses and individuals to take to Section 179 deduction. And then also bonus depreciation. And then in 2020, they made that rolling conformity with federal law. So as that increased with inflation, Iowa coupled with that. Then also they're going to start reducing the corporate rate for corporate tax returns. And then also like federal, they eliminated like-kind exchange for anything other than real estate property. And then, so like I said, as long as revenue was met, they're going to start reducing the individual tax rates to 6.5%, starting in 23. Then they also implemented the elimination of federal deductibility on your Iowa return. Currently, you can reduce your tax or your income on your Iowa return by any federal taxes that you pay throughout the year. And then also, but then you have to pick up your refund from federal. So there's no longer that. Then also they greatly restricted the Iowa capital gain deduction. Pretty much restricted it to farming businesses or farmland. And in 2019, they went ahead and added that you had to be a material participant in farming, had to own the land for 10 years. And then you can also sell it to relatives. In 2018, they came out and said, well, we're only going to allow an Iowa capital gain deduction if you sell your farm to a relative. Then they got a lot of pushback, and I think they backed off of that, allowed a little bit more on that side. So then, as everybody is well aware, March 1st of 2022, Governor Reynolds came out with the new and permanent tax changes to reduce individual and corporate tax rates, provide exemptions for certain forms of retirement income, and also retired farmer rental income, and then also scale back some tax credits. So like in 2018, they came out and said, it was all dependent on some revenue numbers. Well, now they said, yes, we've met these revenue numbers, so we're going to proceed with our tax changes. So most of these are going to be effective for 2023 for the tax returns that we file in 2024. So still 2022 is still going to be based on the old law or the current law. And then in 2023, we'll see some of those changes start to happen. All right. So corporate tax rate decrease. This one's still up in the air. This one's still based on revenue that they're going to collect in 2022. So eventually they want to get it down to 5.5%. But it's all based on the revenue that they generate from corporate taxes. So they say that the benchmark essentially is 700 million that they have to receive from corporate tax rate. And then it's going to be a gradual reduction over time. So, and that's all going to be based on that $700,000 or $700 million benchmark. So just to give you a little, they estimate that for 2022, so the current tax year, they're going to generate $780 million from corporate taxes. So as long as that stands true, the corporate rate should start to fall over the next couple of years, as long as they continue to meet that 700 million. I don't know if that's going to be an increase for inflation over the next couple of years, or if it's always going to be that $700 million. All right, and then what we're going to see, probably the biggest changes is the decrease in individual tax rates. So currently it is 8.5%, 8.53%, and that applies to any taxable income over approximately $78,000. So most people are in that 8.5%. Like I said, in 2023, that will start to reduce, and then ultimately ending at a flat rate of 3.9% in 2026. So here's current tax brackets. And then you'll see a gradual decrease from tax brackets and also the rates. So kind of interesting to see. They say that at least Iowa says that low income will not be, even though the rate is going, technically it's going up, depending on kind of which bracket you're in. That even though it looks like it'll be paying more, Iowa says they will not be affected. I don't really know what that means. They should not be affected. They're still going to, if you get the federal earned income taxes on their federal return, it's still supposed to benefit them on the Iowa return. There is a earned income credit on Iowa, so they're supposed to be taken care of as well, even though it may not look like it. So 2022, not going to see much changes. And then 2021 would have been the same brackets, maybe adjusted a little bit for inflation. But for 2021, this was pretty much the tax brackets. And then we're going to continue to see a decrease. So then they say, Iowa says by 2023, 98% of Iowans with over $10,000 of taxable income will see some benefit. All right, and then just like the corporate return, federal deductibility, like I talked about, is going to be eliminated. There will be a 1-year transition. So I believe that means that any federal taxes that you pay in 2022 for the amount that's due on your 22 return will still be able to deduct that on your 2023 Iowa return. But I guess I'm not sure if that also includes your fourth quarter estimate for federal, but it does mean if you owe a significant amount, it still benefit you on your 2023 Iowa return. Currently, to do the Iowa return, we start with the adjusted gross income. That is going to change to the federal taxable income, and then there will be some adjustments that we will discuss here shortly. So one of the biggest changes that we are going to see is the retirement income exclusion. So this is going to, hopefully, I think Iowa's plan is that it's going to incentivize some retired individuals to stay as residents of Iowa rather than leaving to other states warmer states probably without any state income taxes. And so this is going to eliminate any Iowa taxes on retirement income, and it applies to all individuals. There's no income caps. So if your income's over a certain amount, you only get to exclude half of it. It's supposed to be all income. You get to exclude all your retirement income. So currently, you can deduct or reduce your Iowa income by $6,000, or your taxable income by $6,000 of retirement income. If you're single, and then $12,000 if you're married, filing jointly. Iowa also excludes Social Security and retirement benefits received from federal government. Okay. So who is going to be eligible for the exclusion? That's anybody that is disabled or 55 years of age or older in the year 2023. So that also exempts some surviving spouses, and then anybody that with an insurable interest of the individual. So I'm assuming that's passed down to, kids, retirement income is passed down to the kids, but that only applies in the year of the death. So you're taking retirement income over the next 5-10 years. It only applies for the year of the death. So could be some tax planning for in the year of the death that you're going to receive the retirement income. There's an estimated 300,000 Iowans will have the retirement tax liability eliminated in 2023.
Eric, do you have an opinion on how Roth conversions will be treated? Do you think they'll be considered part of that retirement income, or do we know yet?
I would say they do, as long as they're over 55.
Okay.
I don't think,
They could carve those out.
I don't believe so. Like if you're under 55 and you're going to do a Roth conversion, I think that's going to be taxable.
Okay.
But
Yet to be determined.
Yes.
Yeah, it's my
Yeah.
understanding it's not specifically addressed, but.
it is not, and it has not been. So here's your retirement income definition. Any retirement pay, governmental or other pensions. So deferred benefit plans, annuities, IRAs. Plans maintained by a self-employed individual. So SEPs, simple plans, anything like that is all supposed to be covered. And then deferred compensation plans. And then also the earnings within the plan. Okay, so that's pretty much covers retirement income exclusion. So then we also added a retired farmer lease income exclusion. So this allows any eligible individuals to elect to exclude from Iowa income the net income from a farm tenancy agreement. And this covers any real estate or real property that an eligible individual held for 10 years or more. And that can include a like-kind exchange. So if you did a like-kind exchange and last year, but you held the previous property from 9 years combined, you held them for over 10 years, you're covered. And then also the individual has to have materially participated in a farming business for 10 years or more. And you must meet both of them. It can't be either or. It's got to be both or nothing. Okay, so who is an eligible individual? So it is a disabled or person over 55 years of age at the date of election. So that's same requirements as the retirement income exclusion. They can no longer be materially participating in farming business. Then they have to be the signer of the farm tenancy agreement. So this means that you can't rent out your farm ground to so-and-so, but then still be a member of a corporation or another partnership that's still actively farming. You have to be completely out of farming. And then what is a farming tenancy agreement? It's a written agreement between a lot of farming contracts, or shake of a hand, or mutually agreed upon. This must be a written agreement, and then that person that is leasing the ground must be actively farming it. Can be anything producing crops, livestock, grazing, or supplying feed to livestock. This can include cash leases, crop shares, so Schedule E's and 4835s on the individual returns form. Form 4835 is your crop share leases. All right, and then the interesting part is that it does not include any pass-through income. So if you have so the net income from a farm tenancy agreement excludes any S corporations, partnerships, trusts, or estates. You are not allowed to take the income exclusion. So if you have your farm land in a partnership with you and your wife, you cannot exclude that income, even though it's flowing through on your personal return. You're not allowed to deduct that or take the exclusion. So it's ultimately penalizing anybody that's in a partnership or an S corp or in a trust or an estate. If you're in a K1, you're probably going to be looking for some alternatives on that. But so you can still take it if it's a single member LLC. Most single member LLCs just file it on your Schedule E of your tax return. Your personal tax return, there's not another separate business entity or business tax return that files. So it's could hurt the husband and wife that are in a partnership that own ground. And the other issue with that is that it's an election to either get the lease income exclusion every year, or you get to take the capital gain deduction when you sell the farm. So it's an election to do one or the other. So if you elect to take the lease exclusion every year, you're going to pay capital gains, Iowa capital gains, when you sell the farm. If you elect out of the lease exclusion every year, you get to take the Iowa capital gain deduction when you sell the farm. So if you're planning on holding that farm ground and inheriting it or passing it down to your kids, then probably better to take that lease exclusion every year. But there's going to be a lot of ifs or a lot of scenarios when in 2023 when we have to decide that. So then you're also not able to take the beginner farmer tax credit. That's just, if you lease your ground to a farmer or a new farmer, you get to exclude some, or you get a credit 5 to 15%, depending on a bunch of different variables. Okay. So what is the Iowa capital gain deduction? So currently you can exclude the capital gain from the sale of real estate or from real property used in a business, as long as you held that property for more than 10 years and you actively participated in the business. And then starting in 2023, like I discussed, that is going to be so 2023 limited to farming businesses must have held the property for 10 years and also actively farmed it for 10 years. If the farmer's retired, it's considered to meet the material participation as long as they were in there for 10 years in the aggregate prior to making the election. And then if you were to sell real estate or real property to a relative, the holding period and material participation no longer mattered. So you can hold it for 5 years and then sell to a relative, and still get to use the Iowa capital gain deduction on the Iowa return. So what is real property that qualifies? That would be anything that was used in farming, so all the buildings. And then obviously the real property and then any improvements that you've made throughout the years. This includes woodland, wasteland, pasture land, and idled land that has been used for conservation of natural resources, of soil and water. So if they're getting the CRP income. And then relatives would include lineal descendants, but then it also includes the relative, like if you're selling to an LLC, but as long as a relative is an owner of the LLC, and you still qualify for the capital gain deduction. And it does not say that they need to be a majority owner. They have to have 51%. It just says if they're an owner of an LLC that you're selling to, you still qualify for the capital gain deduction. And so like I said before, the farmer makes a lifetime election to exclude all qualifying capital gains for their lifetime. And then they're not allowed to take the exclusion of the rental income while they're receiving the rent. Any questions on that?
Will you be sharing copies of your slides with us?
Yes.
Thank you.
All right. And then one other change they made, Iowans currently pay taxes on any capital gains for when they sell shares of a corporation. Now, Iowans can make a lifetime election to exclude the capital gain from one qualified corporation or employee stock options. So ESOPs are becoming more common that issue stock options. So now an Iowan can elect to exclude that income as long as the corporation is doing business in Iowa for a minimum of 10 years. And as long as they acquired it by a corporation that they worked for 10 years. Not really sure how Iowa's going to, my concern would be how an employee is going to know that a corporation has done business there for 10 years. But as long as they've been there for 10 years and they've lived or they've worked in Iowa, they should know. I don't know if corporation is going to have to send them something to verify this, or how Iowa's going to track
Well,
this.
how does that work if there's like a merger and acquisition? So say an employee is an employee of a bank, for example, acquired by another bank. Their time period that they were with the organization overall, if they include their previous bank, it is 10 years, but they've only been with the new bank where the ESOP stock is issued as 5 years. I mean, I would say that there'd have to be some rules in there that they wouldn't be able to be included or be able to use this exemption, I would think.
Right. Yep. That's a good question. I don't know. Because there's going to be obviously banks or other businesses that get bought out by public companies that are all over the world. So yeah, it's a good question. I don't know how I was going to track it, or how I was to make sure that people aren't abusing it. Probably going to be on the tax professional, like most things. We'll have to do some digging, but. Okay, and then another change that they made is the Iowa inheritance tax. Currently, lineal descendants do not have to pay taxes on anything that they receive from their parents. But if money is given to a cousin, a nephew, they are supposed to pay taxes on that. And there's 3 different brackets, I believe, 3 or 5 different brackets from 5 to 15% of that income that they receive. And starting in 2021, so this has actually been in effect for a couple of years. This is going to be an effective or a gradual decrease of the inheritance tax. So it's supposed to be 20% each year, and then fully eliminated in 2025. And the tax rate's all based on the year of the death. So some states can take, a year or 2 to get liquefied or be liquefied and finalized before you receive the money. So it's based on the year of death. One credit that I thought was interesting that they took away was the solar credit. I know it's been very popular. And that they took that away for all construction or all businesses that started construction after December 31st, 2021, and then also individuals. Any questions? I know one question that we received is, how this is going to affect donations or, anything of that sort. Honestly, I don't see it changing a lot. I think when Trump came out with the new tax plan for 2018 or 2019, standard deduction was raised to 25,000. They thought donations were going to significantly decrease at that point. I don't have any numbers, but based on our clients, it didn't change much. They continue to give. And most of the time we'd say, hey, did you donate? Oh yeah, I didn't think you needed that anymore. So we, go back, get the donations for the year. Does it maybe make qualified charitable distributions a little bit, a little more popular? Possibly, if you're not deducting or if you're not getting taxed on that retirement income on the Iowa return, do a qualified charitable distribution that you're currently not going to get to deduct anyways on the federal return. So then you eliminate some of your Iowa or your federal income by doing a qualified charitable distribution. Just my thoughts.
Eric, do you still see a lot of your clients doing bunching kind of along that same line where people are still being charitable, right? But being more intentional about bunching them and going with it every other year, every 2 years,
Right.
Big contributions.
Not a lot, but we still, some people do that so that you can, especially if they expect a big influx in income one year, they'll do a bunching or an advisor fund.
Right.
So they're giving a lot in 1 year so that they exceed that standard deduction on federal return. And then they're getting to benefit from that donation. But I don't see any reason for that to change either. That's mainly on the federal return. So, most people aren't giving a donation to receive a tax credit or tax deduction. They're doing it because they've always done it, but
Did anything change with the Endow Iowa limits? And I don't, okay, maybe you know the answer to that. Did they change that limit at all?
Oh, no, it's still $6 million. They did lower the cap though. So now it's limited now to 100,000 per fund or per donation, family unit, whatever, instead of 300,000. So we feel like that is going to help and it will spread out. So more people are likely to get the credit, but we weren't successful in increasing the cap. Yeah.
Eric, you mentioned how Iowa has kind of a transition for federal taxes paid on the in 2023 for the 2022 return,
Correct.
do they have something similar for refunds received in 2023? Are those includable in income at the tax rate in that year, do we know, or?
It's a good question. I saw that we could still deduct it, but I didn't find if we still had to pick up that refund.
Because there seems like there might be a parlay there to prepay a bunch of federal tax in 2022, even if that means we have to pay, a lower tax rate on the refund.
Right, yeah, because you'll get, that's a good point, because you're going to deduct the federal taxes paid at the 8.5%, and then pay taxes on the refund at, well, gradual rate, depending on which tax bracket you're in, but most likely the 6.6%. Yeah, I did not see that. I'll have to pick up the Iowa refund. That'll definitely make tax planning a little bit easier when we're not messing with picking that back up and reducing it for any federal taxes. Good question.
Eric, I put something in the chat too to our remote participants, and actually I'm just gonna quick unplug you here just to put that off. So we go back to hopefully the other screen. There we go. So just want to let any of our remote participants, feel free to put a question in the chat, or if you want to come off mute, if you have a question that you'd like to ask Eric or get some clarification, bring something up for discussion with the group, be happy to have you go ahead and do that. They're so full of information. So much to absorb.
Information overall.
Trying to figure that out. Is there a definition, Eric, you're talking about, with the farming exemption, then also with some of the other ones about materially participating. Is there like a definition of what it means to have materially participated in a farming business, or how does that get decided?
Yes, and it's pretty much as long as it's your primary business.
Okay.
There's an hour requirement that you have to meet. I don't know it off the top of my head. Yeah, it pretty much comes down to hours, what you're doing. But as long as you're actively farming it, you should be good. Meeting those requirements.
We need to stretch.
I know, I was like, now's the time, we gotta ask questions.
Maybe everybody's ready for the test then, you think?
Yep.
Absolutely, oh gosh, I would not take a test, I wouldn't want to take a test.
I don't want to take it.
So do you anticipate, so a lot of these changes are phasing out, what, through 2025? Am I remembering that correctly?
The tax bracket, yes.
Okay, so for that, does that mean nothing's going to change between now and 2025, or?
It is changing. The tax brackets are changing. The tax rates are coming down. It's not going to be, I'm assuming it's not going to be some big change you're going to notice unless you're retired, and you're taking advantage of the exclusion, or you're going to take advantage of the farmer lease exclusion. But no, most working individuals in Iowa will probably not see a very big difference. So don't worry about your tax preparer.
It's okay.
Expecting a bigger refund.
Expecting miracles.
Other questions? Nobody else remotely? No questions? Thought that maybe that John England out there.
I know.
Would have some kind of question.
Mr. England would
That he want to ask.
I know.
All right.
He's probably keeping this much.
Well, very good. Well, if you guys want to join me in thanking Eric for his time. Definitely appreciate that. Just a couple things, little housekeeping details that I want to be sure to let you know about. Our next professional advisor event will be on Tuesday, October 25th. And we'll be back here in this room for those who are here in person, and all are welcome to join us remotely as well. As Eric mentioned, we will be sending out an email to you. We'll have the recording of today's presentation. It'll be the team's recording, so it'll have that look to it. And then we'll also send out the slides, which I'm sure Eric will send to me, and we'll get those included as well. That email will also include some information, like I said, on the continuing education credits to make sure everybody gets those credits that they are looking for. And then also just to get in your head for some future things. I know November seems very, very far away, but November 4th, Friday, November 4th will be our celebration of community, where we will bring together our stakeholders, our fund holders, our community members, our nonprofits, our grantees, those of you who so graciously, refer people to us and help us connect with generous people here in the region. We'll bring everybody together for the celebration of community again this year. So we are very excited about that. Kay, were there any other upcoming events that we would want to make sure that people know about?
I think so.
Okay. So I think everything others. So. All right. Well, thank you all very much. We appreciate you being here with us today, and get out and enjoy this beautiful weather. I mean, it looks gorgeous out. So try to get out of the office a little bit and enjoy that. So thank you all for being here today. We appreciate it.
Thank you.
Thank you.